And so that way it really paints a clear visual perspective as to why you guys should pay attention to this stuff and not the hype and the noise that the mainstream average retail crypto investor tends to gravitate towards paying attention to. All right, cool. So first, weekly Zoom call. This is going to be the last full business week of the month of March. So I wanted to just take a quick second before we do a forward outlook, what to be paying attention to in terms of fundamentals this upcoming week, because we do have a very heavy week ahead of us. We have from the US side of things in terms of our scheduled data. We have PMI figures, we have core durable goods, we have GDP figures. We have the primary inflationary metric for the Federal Reserve, which is the core PCE. That's not until Friday. We have unemployment claims. So we have a lot of key metrics to be paying attention to in terms of fundamental data this week. So it is going to be a heavy week in terms of reports. And depending on how markets shift around, also Zoom calls. On the Japanese front, because those are the two main primary economic epicenters that we've been paying attention to, the Japanese front and the United States front, to determine what the central banks via the Bank of Japan and the Federal Reserve are going to do in terms of rate cuts, rate hikes. On the Japanese front, starting tomorrow, or collectively speaking, tonight, if you're here in the United States, but tomorrow, Asia session Monday, we have some PMI figures on the Japanese front. We have some CPI figures as well to be paying attention to this week from Japan. All right. So the scheduled economic docket is extremely heavy this week, in my personal opinion. Pretty much news events every single day of the week this week. And then for our headliners, our breaking reactive events, we're still paying attention to tariff implications. We're inching closer and closer towards that April 2nd date. We also, obviously, of course, need to be mindful of any geopolitical escalations and tensions in Iran, the Middle East, Israel, Hamas, Yemen, all those things, which played a key factor in the month of March, which we'll go over here in just a second. And then, obviously, of course, the Russia-Ukraine conflict, which the last fundamental report that I read today slated that there are supposed to be further peace talks and agreements taking place later this evening. So we will need to be mindful of that. But I think the last specific date that I saw was something around April 20th. They're supposed to come to some final agreement on this ceasefire debacle. All right. So just be mindful of that. Those are going to be our reactive headlines this week. Any geopolitical tensions, escalations in trade war, uncertainty that might still mount in global markets. All right, we'll get into that in just one second with our fundamental report from today. I also dropped two YouTube videos that are very, very educational, institutional insights from individuals with much more money and capital than you and I, talking about the same exact things that we discuss here in the private CYPRX community, how liquidity and global M2 supply drives market, inflow and outflow, how rate cut decisions, geopolitical uncertainties, tariffs, all of those things are and have been the key drivers of global markets, especially risk assets as of recent.
Bitcoin has this interesting feature, which is why pension funds, hedge funds, and others find it a very interesting asset. Its correlation changes on a regular basis. Right now, it's correlated to equities and risk on markets. It's also highly correlated to M2 on a global scale. It's highly correlated to interest rates, things that affect where people are going to allocate their money.
So we're going to continue to play that, keeping in mind that as the market matures and eventually when utility kicks in, these types of fundamentals and risk assets in terms of cryptocurrency could possibly decouple from other risk asset classes. But right now, we are in a very reactive headline market environment. So let's take a look back. Like I said, we're entering into the last full business week of March. So let's just fully discuss as a community and break down every single thing that happened in terms of fundamental data that took place in March. Starting all the way at the very beginning and then taking us all the way to the end so you guys can kind of physically see outside of institutional delta zones, liquidity and order flow, just how fundamentals can shift perspectives, how certain fundamentals in terms of bullish fundamentals do not outweigh the negative fundamentals, which we'll also get into in this breakdown. And so that way, it really paints a clear visual perspective as to why you guys should pay attention to this stuff and not the hype and the noise that the mainstream average retail crypto investor tends to gravitate towards paying attention to. All right. What you'll notice is that as we go through this information, we're not really going to be talking about the XRP, Ripple versus SEC case, any ETF filings, or any retail bullish fundamentals that market, participants thought were driving sentiment. These are all institutional based fundamentals on liquidity, order flow in terms of safe haven, FX pairs, FX rates, stocks, bonds, equities, so on and so forth, right? So starting back, can you guys see my screen before I start so I don't look like a ass?
Yeah, we can.
Yes,
Thanks.
sir.
Okay, cool. So I understand that each of these pictures are small. I will inflate them as we go along, but so that way things don't get too crowded, I'll just keep them all small until we get to said specific date. So I went through. I thought that this kind of posting from Ruby in the chat was quite hilarious, actually, because this is exactly what I feel like on a day-to-day basis when I'm doing these types of things, right? This dude here. Um, I went through, I backtracked starting all the way from the end of February, so the 28th of February, where we had the last core PCE reading. I like to start there because this week, at the end of the week on Friday, we also get another core PCE reading, and you can see physically in terms of fundamentals, once we talk thoroughly through them, the bullish momentum that it gave the markets as the market started to continue to price in a potential low interest rate environment via Fed rate cuts later on this year. So that's going to play an important role as we factor in our economic projections and where price action could go once we get to that portion of today's video. All right. So starting at the end of February, right? So this was Friday, the 28th of February. We can see the positive momentum in risk assets that came about after we had the release of the core PCE inflationary figures. Again, these figures are lagging. So in February, we got January's reading. This upcoming month in March, on Friday, we're going to get February's reading. And so you can see this is from February 28th, 2025. The Fed's favorite core inflation measure hits 2.6 in January as expected. This as expected vocabulary is important because it just further solidifies that inflation did not tick up. It did not necessarily show signs of disinflation. It kind of just remained flat and the same, which kept the projections that the market can continue to price in further interest rate cuts from the Federal Reserve. So you can see here, this is also a portion of that previous fundamental report. It says the inflation report was good, but we're not done, said Jose Roscoe, Chief Investment Officer at the Americas HSBC Global Private Banking. So again, these are insights and economic perspectives from individuals at large institutions. Okay. We obviously, of course, know that HSBC is a major market participant. So you can see how the market continuing to price in rate cut bets from the Fed positively affected the market. Then we rolled over into March. Here was the transition from the end of February, the 28th, March 1st, and then March 2nd. Does anybody remember? I want to try to ask you guys questions to get the brain juices flowing. Does anybody remember at the beginning of March, this major fake out that we had in the global crypto markets, this pump in price action? What caused this fundamental pump in the market? What caused this market volume and volatility, this intraday price swing? Does anybody remember before I inflate this fundamental report? What caused this on March 2nd?
Isn't that when Trump was speaking about the strategic Bitcoin reserve? Bro, I'm not too sure, but I think it was something around those lines.
Yeah, good job, Dan. I'm pretty sure that was D'Angelo. So good job, right? We had President Trump. He officially announced via a White House report that there was going to be built a strategic government crypto reserve, including assets like Bitcoin, Solana, XRP, and many more. You can see the date, March 2nd, 2025. And this created massive euphoria in global crypto markets and emphasized risk asset optimism, and we saw that pump, right? Now, this pump was extremely short-lived. Pat yourself on the back, D'Angelo. That was a great reiteration. Okay. This pump was relatively short-lived. And here in this community, I remember we hosted a Zoom call and we were telling everybody, look, just because we see an announcement of a global, crypto reserve, this pump alone was not enough to completely engulf all of the market uncertainty after we consolidated for the entire month of February Right here in this area, we had a sharp sell-off due to a whole bunch of uncertainty mounting surrounding geopolitical tensions, escalations, and tariff implications. And this one positive market fundamental was not enough to outweigh all of the pessimistic market perspectives here in this area, right? In a nutshell. Then shortly after, following that, right? This was Sunday rolling into Monday and Tuesday's price action. We had, obviously, of course, our fundamental analysis come in accurate. You can see this is March 3rd. Trump will set exact levels for Mexico, Canada tariffs coming Tuesday, says U.S. commercial chief. On March 2nd, U.S. Commerce Secretary Howard Lutnick said on Sunday that tariffs on Canada and Mexico will go into effect on Tuesday, but that U.S. President Donald Trump will determine whether to stick to the planned 25% level. So again, uncertainty surrounding tariff implications and trade wars started to affect global risk sentiment, and all of that positive market momentum that was driven by both the lower inflation reading and the core PCE on February 28th and the announcement of the strategic Bitcoin reserve was outweighed by the market pessimism or the market uncertainty, which drove more demand for safe haven assets. We saw gold continue to increase. We saw outflow of risk assets like stocks and crypto, and market uncertainty continued to mount, and we saw that sell off. All right. So that was pretty much in a nutshell almost the very beginning of March. As we rolled over from Monday into Tuesday, all right. So here is, you can see Monday the 3rd rolling over into Tuesday, March 4th's price action. All right. Looking at this tiny bounce in bullish price action from roughly around 2.65 trillion up into about almost $3 trillion, we had another major fundamental docket come out. You can see how these fundamentals and what Trump says, you can see here, both two Trump headlines driving back market optimism. Trump says that the tariff implications are going to have little disturbances. So all of the uncertainty surrounding the previous day's fundamentals surrounding tariffs slowly started to subside under Trump's comments. But then also what gave the market some optimism intraday was that Trump talked about, for the first time at the beginning of March, Russia providing strong indications that it's prepared for a peace agreement, right? So at the beginning of March, we started to see peace talks mount between Russia, Ukraine, and United States involvement. And you can see, again, positive developments surrounding tariff implications, positive developments surrounding global geopolitical tensions tend to drive market optimism back into risk assets. And you can see that we probably saw some profit taking at the exact same time on gold if I had the chart correlated and pulled up. And then we saw that inflow back into risk assets intraday, right? That intraday momentum did not break the previous high, and instead we created a lower high coupled with more market uncertainty. So rolling into the next trading session, this is roughly Wednesday to Thursday, March 5th and 6th. You can see on that day, we got an ADP jobs report print, and that jobs report print sparked recessionary fears. It showed signs of an economic slowdown, much more severe than previously anticipated. So in our reports, okay, this is something that I try to go over with you guys in detail. I believe Nick or DESM8 in the chat, in the Discord chat, right? You guys know him as that username and we know him as Nick, right? He asked this question in a previous Zoom call. How do you tell that the market fundamentals come out either extremely negatively affecting the markets or extremely positively affecting the markets? And this was a really good report that backs what it is that I try to teach you guys. So you can see on Wednesday, the 5th of March, the exact same day that the market topped out from the previous optimism and started to pull back via a risk-off market mood, we see this ADP non-farm employment change print miss not only the previous reading, which was at 186,000, but also missed the market forecast, 141,000, and came out almost 68,000 jobs less than previous and forecasted readings. When we're looking at this, so there's the data. Here's the report. It says, private sector job creation slowed to crawl in February, fueling concerns. This is key vocabulary sentence right here. Fueling concerns of an economic slowdown. Anytime that you see that, fueling concerns or mounting market uncertainty or economic contraction or economic slowdown, it usually tends to reflect itself in more demand for safe haven intraday and less demand for risk assets, right? Then also on the same day, you can see another key vocabulary, slowing growth, worries. Those are both key vocabulary words right there that usually tend to reflect itself in outflows of risk assets. And it's talking about brewing on worries of President Donald Trump's tariff plans that will spark another round of inflation, right? So these were those fundamentals on that Wednesday that started the peak and led into this pullback. Moving on into Thursday, we had another fundamental docket. You can see here, this is talking about stocks in those two breakdowns that I tried to get you guys to watch here. Both of these reputable individuals from large financial institutions or hedge funds, wherever they stem from, talk about how crypto markets are heavily correlated right now to global equities and stock markets because they are risk assets, right? Here you can see it says stocks fell sharply on Thursday and remained lower after Trump initially failed to announce a reprieve for Canada tariffs. The market is in the red during Trump's presidency in part because of uncertainty via the administration on its trade policy that it has caused. So anytime that Trump does not give the market certainty or verification in what it is that he's going to do in terms of his tariffs, it usually tends to reflect itself in market uncertainty. Market uncertainty tends to lead to larger investors than you and I seeking safe haven demand, right? And we can see that reflected in terms of price action. So, okay, so that was the first week of March, right? So the first week of March in a nutshell. The first week of March ended here, Friday rolling over into Saturday with this kind of sideways consolidation before the weekend sell-off, which we'll get into in just one second, right? So this in a nutshell was the first week of March. And you can see how the institutional fundamentals, when I say institutional fundamentals, I'm talking about US data, global economic, geopolitical tensions, things that these market makers are actually tentative of, right? Market makers are not sitting on Twitter looking at retail perspectives. They have access to Bloomberg terminal, Reuters terminal, economic data, quant algos, all these things that deliver them this information probably minutes before retail traders actually get this information. And then that allows them to shift what it is that they're going to do in terms of liquidity flows in the market, right? These are the things that they're paying attention to. We have multiple people in this community, by the way, that have worked at either brokerage companies or hedge funds that will confirm exactly what it is that I'm saying. Christian, being one of our most profitable traders in this community, is one of them who worked at a brokerage company for, I believe, over 2 years, right? So again, first week of March in a nutshell. Rolling into the weekend, the first weekend of March, this was a Saturday and a Sunday report. And again, it stems and falls in line with market uncertainty surrounding geopolitical tensions tending to weigh on risk assets. So you can see here this report, March 8th and March 9th, which was a Saturday-Sunday combo. We had mounting geopolitical escalations and tensions in Russia, Ukraine. Russia strikes on Ukraine, kills at least 23 people. Russia strikes continue in Ukraine as US pauses sharing, da 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 da, right? Interestingly enough, again, you can see how in previous reports, right? So look at the negative implication that these risk factors have. Okay, so if you guys remember right here, right, this was a Tuesday, right? Monday rolling into Tuesday, we look back and we can see, again, positive fundamentals surrounding Russia-Ukraine news, where we see Trump, what did he say? For the first time, Russia provides strong indication that it's prepared for peace. March 4th, 2025, Trump posted this on Truth social media, right? And we can see the inflow into risk assets that that had. Negative implications, however, surrounding these geopolitical escalations and tensions, the market actually realizing, okay, the headlines surrounding the peace talks and everything like that actually aren't really mounting to anything, right? We keep seeing positive peace talks, positive peace developments, but then Russia and Ukraine continue to fight the war, right? And when that happens, the market realizes that, okay, it's not as positive as previously thought. Buyers get trapped underneath of these areas of interest. Sellers overpower those buyers, and the market dumps. And we see more demand for safe haven, less demand for risk assets. And so over the weekend, the first weekend in March, Saturday and Sunday, we saw mounting price pressures on risk assets as geopolitical tensions and escalations mounted. All right. That sent us into this Monday's weekly low at around $2.45 trillion, which is the low for March as of right now, unless this week, obviously, of course, unfolds in a massive risk off environment. And from the $2.45 trillion range, we had a huge week of economic data that brought some risk asset optimism back into the market. All right. So here is the entire week, Monday, March 10th through Friday, March 14th, where we got the JOLTS job openings, where that data showed some slight signs of optimism. You can see here the previous reading was 7.51 million. The market expectation was 7.65 million. And the market actual came out at 7.74 million, which was higher than the previous and the market expectation, which showed signs that the US economy is still relatively strong. What does that tend to do? When data comes out stronger than both previous and expectation readings, in previous reports, we saw signs of economic uncertainty surrounding a recession, but the data comes out showing signs of economic strength. Someone tell me what that does for the market environment. What does it do? It's a very easy vocabulary word. I kind of just gave you the answer. What does it do?
Risk on.
Right? It flips risk on because it eases recessionary fears. Intraday, right? Intraday, market participants are more inclined to take on risk because the actual data is not pointing towards a recession, right? Following that, on Wednesday, March 12th, and on Thursday, March 13th, we got disinflation readings in both the CPI and the PPI readings, both month over month and year over year. I'm not going to go into that in detail, but continued signs of cooling in the inflation figures, obviously, of course, further support rate cuts from the Federal Reserve. The rate cut expectation previous or prior to the CPI and PPI reading was hovering at about 1 to 2 cuts being priced in 2025, and the market actually elevated those expectations via rate cuts to anywhere between 2 to 3 cuts this year because of the lower PPI and CPI figures. Then we also had a better unemployment claims. You can see here the unemployment claims reading. Previous reading was 222,000. The market was expecting 226,000, and it came out better than both the previous and the market expected reading at 220,000, right? Then the consumer sentiment came out, and that came out extremely downbeat, coupled with a higher inflation expectation, but the actual data went against what consumers were expecting in terms of the market sentiment and inflation expectations, right? So the data is showing that disinflation is continuing and the labor market is still showing signs of strength, but consumers are pricing in that due to tariffs, these things are going to negatively affect an inflation in the future, but the current data right now is saying otherwise, right? And so we continued throughout the week, the second week of March, to see a bullish recovery in risk assets, right? So you can see each and every single one of those days, we saw, collectively speaking, a positive risk on sentiment where the market start to create a recovery from previous week's outflows. Also, we saw a Reuters report and breaking headlines, March 13th, 2025. Russia has presented the US with the list of demands for a deal to end its war against Ukraine and reset relations with Washington. So this was yet another positive fundamental development surrounding the Russia-Ukraine tensions, right? And so this was the second week of March. We saw a slight bullish recovery from the previous week's bearish price action. Nothing too significant. We did not break into new all-time highs, but in comparison to this week, you can see the fundamentals are completely different, right? So we had bad economic data at the beginning of the week. We had mounting uncertainty surrounding Russia, Ukraine, and that all led off into a sell-off. Flip that on its head, we got the complete opposite. We got data that eased recessionary fears. We got cooling and inflation, and we also got positive developments surrounding geopolitical tensions. And we can see how that reflected itself in a positive intraday risk environment. What I want you guys to pay attention to, though, is how retail was extremely optimistic, almost overly bullish, right? The second week of March, at the same exact time, we saw ETF announcements on the XRP front. We saw retail get overly optimistic from a fundamental standpoint. We're still not in an environment where the positive fundamentals, you can see it, right? The positive fundamentals are not outweighing price action and sellers and the negative fundamentals. So that's why I'm trying to teach you guys to still be mindful. We're holding this slight bullish recovery, but you can clearly see that we're not seeing aggressive buyers entering into the market yet. Aggressive buyers meaning that we're completely breaking previous bearish sell pressure, and these positive fundamentals that we're seeing intraday are not enough to outweigh market uncertainty. Market uncertainty that's keeping a lot more demand in safe haven assets like gold right now, which is still sitting at all-time highs, right? So that was the second week of March. Rolling into the third week of March, we had again a Friday, Saturday, Sunday overlap. Notice how the volume, the volatility slightly slows down Friday into Saturday, and then it picks up again Sunday. So starting with the third week of March, right here in this area. Okay, this was last week's price action. Starting with Sunday, does anybody remember before I engulf this fundamental piece right here on Sunday last week, what was the key driver of this quick little tiny pump in the markets from roughly around 2.6 to $2.7 trillion to kind of liquidate these highs before we rolled into Monday? Does anybody remember?
China's stimulus plan.
Good job. Nailed it on the head, right? You can see here, word for word. March 17th, 2025. Risk on sentiment improves amid China's stimulus measures, right? We get a nice little tiny liquidity injection into the markets. It usually tends to reflect itself in positive risk sentiment, right? That was very, very short-lived because the day after, on Monday last week, does anybody remember what happened? What breaking headline took place surrounding geopolitical tensions the day after?
Iran attacks, I believe.
Yep, good job, Avida. You're right. So the day after, on Monday, everybody got extremely euphoric. I remember it was a Sunday. The market was relatively green. We were up like, I don't know, let's look at this in terms of measurement. We were up $98 billion on an intraday move in crypto, which makes everybody extremely euphoric, right? Following that, the markets came in, geopolitical tensions and escalations, fear, uncertainty, and doubt always outweighs optimism. Remember that. We see here Middle East tensions, tariff jitters, fuel gold's rally. March 18th, this is the day after the stimulus injection from China. Gold rose 1% to hit a fresh record high. You can see here Israel airstrikes killed more than 400 people in Gaza, threatening a 2-month ceasefire. This took place on Monday, right? Nothing too significant, but again, you can see sellers still overpowering buyers. So we have, yet again, another perfect example of positive fundamentals here being outweighed by negative fundamentals, right? Any buyers that were trapped underneath of these areas in leveraged positions were liquidated with this intraday sell-off, right? Rolling over into, I believe, Tuesday, Wednesday, Thursday's price action, give or take, okay? We had a whole slew of economic data. We had Bank of Japan, monetary policy decision. We had the FOMC meeting. We had Jerome Powell speak. We had developments, breaking headlines surrounding Russia, Ukraine. We had, I believe, on the same day, it was the same day that Brad Garlinghouse officially announced that the SEC versus Ripple case, the SEC dropped the case or dropped the appeal or whatever it was that happened. Again, I really don't pay attention to retail things, so I don't remember exactly what took place. I just remember him at the Digital Asset Summit last week. He announced it to the general public. He posted it on Twitter, and all of that led to a whole bunch of market euphoria and a nice recovery in risk assets. Okay. And so here in our breakdown, these are just two screenshots from our fundamental reports. You can see we were talking about this. So we saw risk on intraday markets due to resilient U.S. economic data that alleviated recessionary concerns. We saw Federal Reserve hold rates steady with Chair Jerome Powell reinforcing confidence in the economic strength and controlled inflation while still opening the door for 2 to 3 potential rate cuts this year. We had the Bank of Japan maintaining its cautious stance without signaling an aggressive rate hike cycle. We had de-escalations and tensions in the Middle East and Russia-Ukraine conflict. And we had no new tariff announcements or threats from the United States. So this was a portion, I believe, from our March 19th fundamental report. And we talked about in detail, especially surrounding Bank of Japan and Governor Ueda's comments, which were one of our big concerns. He delivered more dovish comments, but more intensively. For our breaking and reactive headlines, you can see here it says later the US and Ukraine President Zelensky announced a partial ceasefire agreement with Russia focused on energy infrastructure, while positive investors remain skeptical until a long-term truce confirmed. So this all led to intraday buying of risk assets. Now, again, even though we had a pump from the weekly low of around 2.62 trillion up into a weekly high of 2.81 trillion, you can see that this was not enough bullish momentum to break the previous week's high coming in the same area at 2.81 trillion. And interestingly enough, that was the same exact time where we had the March 8th, March 9th Russia-Ukraine situation escalate, leading to more demand in safe haven and less appeal to risk assets. So even though we had intraday buyers come in at the end of last week, or give or take middle of last week, Wednesday, Thursday, Friday, it was not enough bullish momentum to completely outweigh and overpower sellers, continuing to show us that we still need to be reactive to these headlines and understand that until we see a slew of economic data and fundamental headlines that make risk assets more appealing than safe haven assets, we're still going to be in this environment where we can see these bullish recoveries. I'm not knocking them or saying that they're not going to exist, but as soon as breaking headlines come out, mounting fear, uncertainty, and doubt, we can expect deeper retracements and corrections until buyers completely come in and feel confident enough to be holding their capital in risk assets instead of safe haven. And right now, that is not the current environment. I'm not saying it couldn't change because this week is going to be very impactful moving forward, but we just need to continue to be mindful and play these markets accordingly and not get distracted by the average retail hype. Okay. So moving forward, you guys know and understand long term we're still bullish. I'm buying at these discounted prices under the assumption that long term we are still going to experience a massive market recovery once the current market uncertainty subsides, but also still playing the downside risk, understanding that the levels which I'm buying at now might not hold and we might see another market downturn if uncertainties and geopolitical tensions, escalations, tariffs continue to mount, creating more demand for safe haven. For example, economists are projecting that gold's going to hit $3,500 per ounce, right? So you have to assume that if gold right now is trading at $3,040, $3,030 per ounce, what's going to create more demand for gold to take it from whatever where it's trading at now to $3,500? Well, that's going to be more economic uncertainty, fear, recession fear, inflationary fear, maybe even a possible uptick in inflation, so on and so forth. And that's usually going to reflect itself in sell-offs and risk assets. Okay. So just be mindful. Last but not, excuse me, last but not least, this was a fundamental piece that came out Thursday, rolling into Friday. And this is what led to this market pullback or the market's inability to break above the previous high at 2.81 trillion. You can see geopolitical pressures and global central banks, Russia-Ukraine tensions, a new drone attack on Thursday on the Russian airfield, along with heightened bombardments in eastern Ukraine, have rattled markets. It says here, for now, on Thursday, the fighting continues, right? So even though we saw some positive developments throughout the middle of the week, leading to this market optimism and bullish price action, shortly thereafter, the day right after that, we saw another attack in the Russia-Ukraine debacle, right? So in a nutshell, that has literally led us up to where we're currently trading at now. All in all, now we are in and operating still in this weekend's price action, Saturday into Sunday. Okay. Market is currently up right now about $36 billion on the day. We're still holding above the weekly lows. And in terms of price action and looking at structure, right, we did see a sharp sell-off at the beginning of March. We're still holding intraday higher lows in the form of previous week's price action, but we're failing to break above previous monthly highs. All right, so if I completely get rid of all this, okay, here is March's monthly high coming in at about 3.1 trillion. This is the presidential announcement of the crypto reserve. After that, we had a whole bunch of mounting geopolitical tensions, data, so on and so forth, that created way more demand for safe haven assets. And during the month of March, we completely sold off all the way down to 2.43 trillion. Since then, we have staged a slight market recovery, but you can clearly see in terms of price action, sellers, in terms of buyers, sellers are still in control of this market, right? We have only recovered about half of March's price action sell-off. Okay. So now that leads us into what the remainder of this week, the remainder of March, and heading into April could look like. All right. So let's create some realistic projections in terms of both price action and talk about fundamentals ahead.